Welcome back to Morning Trade Live. Time to focus on the big picture ahead of the opening bell. Joining me right now, Barry Knapp, Director of Research, Ironside's Macroeconomics. We have a lot of news to go through, lots of economic data. But how are you feeling overall, as we're not too far away from record highs?
Well, unlike a lot of the people that are doing the same job that I used to have when I was at Barclays, when I was the equity strategist, we never pulled our full year forecast or lowered our price target or otherwise. When we got to the lows, we thought that the market was fully pricing in a recession that was unlikely to come, and that even if it did, the return outlook was still pretty good. So I think we're on track for a decent year. I do think, though, that the dynamic that made us turn cautious back in February, this idea that we would go through a real growth slowdown, as you know, we went through a process Treasury Secretary Bessent called detoxing, right? That moving from government spending driven growth to trying to restart private sector investment. I think that process is well underway, and spoiler alert, my note this week is going to be titled "Not So Solid," right? And that's a reference to Fed officials who continuously describe the economy as solid, the labor market is solid. In fact, things are growing, and you could see that in the personal spending numbers this morning. We've seen it in just a series of data releases, and I think we'll see it next Thursday when we get the employment report. And this is a bit of an issue going into second quarter earnings season. What it looks to us like is expected right now, at least, is if you take out tech and communication services, the two sectors that are really big beneficiaries of the Gen AI spending boom, earnings are expected to actually fall 1%. And that's on pretty paltry 2.25% growth. Now, earnings always beat. We know the numbers won't be that weak, but this is a decided slowdown in core earnings growth. And it underscores that growth has slowed sharply. Consumer spending was running at nearly a 4% pace in the second half of last year. It was 1.2 in the first quarter, with services spending down to 0.6%. Actually, with the revision this week, it's even lower than that. And then we know that the first 2 months of the quarter, we just got the data this morning, spending has slowed, continued to slow. And so consumption's slower, government spending is down, capital spending has not yet rebounded. That's a key theme for us, as we think it will, but it hasn't yet. And you've just got all cylinders of the economy decelerating here as we go through this detox process. And so can the market look right through that? Maybe. We've got favorable tax policy coming. The Senate does want to make the corporate tax incentives permanent. That's a big positive from our perspective, and part of the reason why we're overweight industrials, financials, materials. And we could get a Fed easing starting as soon as July, if we do get a weak payroll report next Friday and a fairly benign CPI report in the middle of the month. But the Fed is a bit of an issue here. Policy is still having this negative fallout on growth, and it's questionable for us if we can just continue this momentum straight higher. We think we're going to end up, somewhere with a 10% or so return, call it 6,600 at the end of the year, but we may be in for a little bit of a rocky patch, I guess would be my bottom line.
That's pretty. Yeah, look, if you can get to 6,600, wow, imagine that. I guess a lot of folks are really betting on cuts. 2 to 6 cuts in the next 18 months, let's say, right?
Yeah, we've been in the 4 cuts for this year camp all along, and of course, market expectations around that have have varied widely. At times, our numbers, our forecasts look spot on, but like our price target, we never changed it, because we do still think that if the Fed does skip in July, there's a very good chance they will kick us off with another 50 in September, and we'll wind up with a very similar path as we had a year ago, where they do wind up doing 100 this year. And that's because the housing market and the small business sector really need it. And one of the clearest ways to see this is if you look at the return on equity in the largest banks, it's about at 11.5% or so, a very good level where they can build capital, they can provide credit to the U.S. government, to the economy, although loans from big banks are, as a percent of their assets, are down a lot. But the small banking sector, which is my main point here, that return on equity is at about 7.7%, well below their equity cost of capital. And the small banking sector, which provides credit to real estate developers, provides credit to small businesses that are dependent and receive their financing on a floating rate basis, are really struggling. So I think what we're going to learn in early August when we get the first estimate of the annual benchmark revision to employment is that we've had the fourth consecutive negative annual downward revision because we're overestimating small business employment. My broad point here is the small business sector is struggling. Real estate developers are really struggling. The supply of housing is being impaired. And the Fed really needs to get on with these rate cuts to strengthen the foundation of the economy and the labor market in particular. And their ideas around inflation are just wrong. And they got transitory wrong during the pandemic because they underestimated the impact of a big surge in government spending. And we have the opposite going on now. And they're not understanding how inflation really works, other than Governor Waller and presumably Governor Bowman, who are advocating for more immediate cuts.
Yeah, and look, we'll get a new Fed chair next year. To your point, many are clamoring for some cuts sooner than later. At this point, I do wonder if any of the economic prints really scream something to you. But as an investor, you want to stay fully invested?
Well, reasonably fully invested. We've carried a reasonably high cash allocation through most of this process, in large part because our sector exposures are fairly aggressive. They're fairly high beta. So the way we're framing out in terms of themes, how we should be invested, we do think that we are on the verge of a capital spending boom that could last through the business cycle. It's long overdue. All the conditions are in place, particularly if, as I suggested earlier, the Senate makes immediate expensing for equipment investment permanent. They make more attractive taxation or depreciation allowances on factory investment permanent. They restore their favorable R&D investment permanent. So that will help the industrial sector. Financials will benefit from that in a second order effect as they finance that investment. That'll be good for materials. It'll be good for tech. So that investment theme, I think, is a strong one. Now, one thing Chair Powell said that we do agree with is someone's going to eat the tariffs. And part of the reason that we're going to get tepid or expected to get tepid earnings growth in second quarter earnings is consumer-facing companies are going to struggle with their margins. And so consumer staples, consumer discretionary sectors are sectors we would avoid. They're going to have to absorb these tariffs. They do not have pricing power. They cannot pass the tariffs through, and they're going to have margin compression. Those sectors' performances reflect that, and we would continue to avoid them. We'd avoid the healthcare sector as well. The MAHA movement is just gaining momentum, and there's big disruption coming through that sector as well. So that's kind of our avoid stuff. But anything benefiting from investment, including utilities, we would be investing in and avoiding the sectors that are going to struggle with pricing power and having to absorb the big tax on imports, which is tariffs. And so it's kind of how we're thinking about things broadly.
Yeah. Barry, it's great to see you. I'm so glad you're with us, and we'll have to check back with you soon. Barry Knapp, Ironsides Macroeconomics. Thanks, Barry. Have a great day. Appreciate it, and a great weekend.